Welcome back to The Explainer. Look, today we're on a mission to totally demystify some of the most stubborn financial jargon out there, and we're going to do it in just a few minutes. Because let's face it, accounting terminology is practically a known cure for insomnia. But today, we're fixing that. If you've ever felt tripped up by this language, or if you've been just memorizing rules without truly understanding the why behind them, you are exactly where you need to be.
Have you ever actually wondered why accountants insist on using the words debit and credit instead of, just saying add and subtract? Well, here's the thing. In the everyday world, we're taught that a debit means money is flying out of our bank account and a credit means money is coming in, right? But in accounting, that is fundamentally incorrect. Debit doesn't always mean money goes out, and credit definitely doesn't always mean money comes in.
So here's our quick roadmap for today's explainer. 1. Unlearning debit and credit. 2. The double entry system. 3. The core accounting equation. 4. The rules of increase. And finally, 5. Transactions in action. Let's jump right in.
Section 1. Unlearning debit and credit.
Okay, so first things first, it's time to completely let go of your personal checking account habits. Seriously, in normal conversation, yeah, we just add and subtract. But in accounting, debit and credit are actually these super powerful structural tools. We really need to stop thinking about just adding and subtracting cash in a simple little ledger. Instead, we've got to realize they're designed for something much, much bigger and way more robust than your basic personal bank account. They're literally directional signals within a much broader system.
Which brings us to Section 2, the double entry system.
I want you to think of the double entry system kind of like a giant financial seesaw. Basically, it's a framework where every single business transaction affects at least two accounts. One account always gets a debit and another always gets a credit. It's actually a brilliant system because it forces absolutely every transaction to impact multiple areas, which keeps everything in perfect harmony. You can't just change one isolated number. There's always a dual effect.
All right, moving on to Section 3. The core accounting equation.
Assets equal liabilities plus owner's equity. Just think of assets as what the business owns, liabilities is what it owes, and equity is what's left over for the owner. Honestly, this equation right here, it's the gravitational pull of the entire financial universe. Literally every single transaction a business makes has to keep this specific formula perfectly balanced. If your assets bump up on the left side of the equal sign, well, then your liabilities or your equity on the right side simply must increase too, or another asset has to drop down. It's all about maintaining that perfect equality.
Now for Section 4, the rules of increase.
Okay, here is where the magic actually happens. To increase your assets and your expenses, you use a debit. But to increase your liabilities, equity, and revenue, you use a credit. Now I know this is exactly where most people get tripped up, but when you see it laid out systematically like this, the structural logic becomes so much clearer. A debit isn't inherently good or bad, it's literally just a mechanical lever that we use to bump up certain types of accounts.
And, because this is a perfectly balanced system, the inverse is always true. If a debit increases an asset, then naturally a credit has to decrease it. And it works the exact same way on the flip side. If a credit bumps up your liabilities and owner's equity, then you've got to use a debit to drop them down. It's just a precise mirror image. Honestly, once you lock in the rules for what increases an account, figuring out how to decrease it is a total breeze. It's just the exact opposite.
Let's put this into practice with Section 5, Transactions in Action.
Congratulations, you are now an entrepreneur. Let's look at scenario 1. Imagine you're starting a brand new business, and you decide to invest $10,000 of your own hard-earned cash to get it off the ground. Let's look at exactly how the double entry system handles a move like this.
Okay, so first up, your business just got a huge influx of cash. Cash is an asset, right? And as we just learned, assets increase with a debit. So boom, we debit cash for $10,000. But hold on, where did that value actually come from? Well, it came from you, the owner. That means your capital, which is an equity account, also goes up. And since equity increases with a credit, we credit capital for $10,000. One debit, one credit. The whole equation stays perfectly, beautifully balanced.
All right, how about scenario 2? You're going to need a place to sit, right? Your business is up and running, so you take $2,000 of that cash and you go buy some office furniture.
Now, what's really cool here is that even when we're dealing entirely on just one side of the equation, literally just swapping one asset for another asset, the system doesn't even break a sweat. Your brand new furniture is an asset that's going up, so you guessed it, that's a debit. But the cash you used to buy it is an asset going down, making that a credit. Flawless. The double entry rule holds up every single time.
So, if you're going to take a screenshot of absolutely anything from this explainer today, make sure it's this golden rule right here. Assets and expenses increase with debits. Liabilities, equity, and revenue increase with credits. Seriously, if you can just commit this basic framework to memory, the rest of the entire accounting equation is going to naturally fall right into place for you. No more stressful guesswork, I promise.
Learning this stuff is honestly like cracking the code to a brand new language. Once you unlearn that old habit of just purely adding and subtracting, you start seeing the underlying matrix of the whole business world. So, I want to leave you with a final thought to chew on today. If every single transaction in the world truly has a dual effect, what exactly is the hidden other half of the very next purchase you make? Thanks so much for joining me on this explainer, and I will catch you next time.